Now let's dive into the critical area of group audits, specifically focusing on how we handle the reporting dates of components during consolidation. Ideally, every component's financial statements should be drawn up to the exact same reporting date as the parent company. However, in the real world, this isn't always practicable. When a component has a different reporting date, we can't just ignore the gap. We must make adjustments for any significant transactions or events that happened between the component's date and the parent's date.
Now pay close attention to the time limits here, as these are frequently tested. If the company follows accounting standards, the gap between reporting dates cannot exceed 6 months. But if they are following IND AS, that window shrinks to a maximum of 3 months.
As the auditor of the consolidated financial statements, your responsibility is to review the results of these components for the intervening period. You need to ensure that any material events affecting the financial position, results of operations, or cash flows are properly recognized, either through adjustments or disclosures.
Furthermore, remember the fundamental accounting assumption of consistency. You must check if the length of the reporting periods and the year-end dates remain the same from one year to the next. If there is a material change in these periods, the entity must disclose the change and how it was treated. Finally, let's talk about disclosures. There is a very important circular from the Ministry of Corporate Affairs and Guidance in ES 21.
The key takeaway here is that consolidated financial statements are not just a copy-paste job. A company should not simply repeat the disclosures from the separate financial statements of its components. Instead, it should only provide disclosures that are relevant to the consolidated entity as a whole. Your role as an auditor is to examine the notes and ensure that everything required by the applicable standards is included to present a true and fair view of the consolidated financial statements. Keep this logic in mind, and you'll master the nuances of group audits.
Now, let's dive into the critical requirements for disclosures in consolidated financial statements. As an auditor, your primary goal here is to ensure that the consolidated picture provides a true and fair view.
First, you must examine whether any additional statutory information disclosed in the separate financial statements of the parent or the subsidiary is so significant that it impacts the overall consolidated view. If it does, it must be brought into the consolidated statements. You also need to ensure that the general instructions for preparing consolidated financial statements, as laid out in Schedule 3 of the Companies Act, 2013, are strictly followed.
Now, there is a specific requirement for transparency regarding the components of the group. For the parent and every single component, including foreign subsidiaries, you must disclose 3 key metrics separately. 1. The amount of net assets and what percentage that represents of the total consolidated net assets. 2. The share of profit or loss and its percentage relative to the consolidated profit or loss. And 3. The amount of other comprehensive income, or OCI, and its percentage of the total consolidated OCI.
When it comes to consolidation adjustments, such as the elimination of intergroup transactions, you have two options. Either disclose them as a single separate line item or adjust them directly within the information provided for the parent and its components. Now, a very important point for your exams. Not everything in the separate financial statements needs to migrate to the consolidated statements. While IND 110 doesn't provide a specific exclusion list, based on Section 129.4 and the relevant MCA circular, the rule of thumb is that only information relevant to the consolidated entity should be disclosed.
To make this practical, here are 3 specific examples of what you can typically omit from the consolidated notes, even if they appear in the separate statements. First, the source of bonus shares, whether they were issued from profits, reserves, or the securities premium account. Second, the details of unutilized monies from a share issue and where those funds are invested. And third, the specific disclosures required under the MSME Development Act of 2006.
Now, let's dive into the specific reporting requirements for group audits, focusing on the detailed disclosures required for investments, imports, and foreign exchange transactions. This part is crucial for ensuring transparency in the consolidated financial statements.
First, let's look at the statement of investments. The company must provide a detailed breakdown whether these investments are classified as financial assets or as stock in trade. You need to clearly separate trade investments from other investments. It's not enough to just give a total. The statement must list the names of the corporate bodies where the money was invested. If multiple companies are under the same management, that must be explicitly indicated. This includes all investments made, even those occurring after the previous balance sheet date, along with the exact nature and extent of each investment.
Moving on to imports, the auditor needs to verify the value of imports calculated on a CIF basis, that is, cost, insurance, and freight. This must be broken down into 3 specific categories: raw materials, components and spare parts, and capital goods. Along with the value of imports, we have to look at the expenditure in foreign currency. This covers payments made for royalties, know-how, professional and consultation fees, and interest.
To get a full picture of the production process, the company must also disclose the value of all imported raw materials and components consumed during the year, compared against the value of indigenous or locally sourced materials consumed. The key here is to provide percentage of each relative to the total consumption. Now, regarding outflows of funds, any amount remitted in foreign currency for dividends must be reported. This requires specific details: the number of non-resident shareholders, the number of shares they hold that earned those dividends, and the specific year the dividends relate to.
Finally, we look at the earnings in foreign exchange. These should be classified into 4 clear heads. First, the export of goods calculated on an FOB basis which is free on board. Second, income from royalties, know-how, and professional fees. Third, interest and dividends. And fourth, any other income with a clear description of its nature.
As a final reminder, while these specific requirements are vital, always remember that the auditor's overarching responsibility is to ensure that the consolidated financial statements comply with all applicable accounting standards in the prevailing legal framework. Keep these details in mind as they are essential for a thorough and compliant audit.
Now let's dive into the critical aspects of management representations and reporting when we are dealing with consolidated financial statements. First, let's talk about management representations. According to Standard on Auditing 580, the auditor must obtain written representations from management and, if necessary, those charged with governance. In the context of a group audit, the auditor needs formal evidence that the parent company's management acknowledges its responsibility for a true and fair presentation of the consolidated financial statements, ensuring they align with the applicable financial reporting framework. Essentially, the parent management must explicitly state that they have approved these consolidated statements.
But it doesn't stop there. The auditor will also seek written representations on specific matters that are material to the consolidated accounts. For example, you'll want management to confirm that all components have been included, meaning the list of subsidiaries is complete. You'll also need them to confirm the identification of reportable segments, the disclosure of all related parties and their transactions, and most importantly, that the consolidation adjustments, including the elimination of intragroup transactions, are both appropriate and complete.
Moving on to reporting, there are 2 primary scenarios you'll encounter. The first is the simplest, where the parent's auditor is also the auditor for every single component in the group. The second scenario is more complex, where the parent's auditor is not the auditor for one or more components and must rely on the work of other auditors. When you are preparing your final report, you must keep the core reporting standards in mind. This means following SA 700 for forming your overall opinion, SA 705 if you need to modify that opinion, and SA 706 if you need to add emphasis of matter or other matter paragraphs. And here is a key tip. If you are using the work of other auditors, you must also strictly adhere to the requirements of SA 600.
Now, let's dive into the reporting requirements for group audits. This is a critical area for your exams, so let's break it down into 2 main scenarios.
First, consider the situation where the parent company's auditor is also the auditor for every single one of its components. In this case, the process is relatively straightforward. When you're drafting the audit report, your primary focus is to confirm whether the principles and procedures for preparing and presenting the consolidated financial statements as laid down in the relevant accounting standards have been followed. Now, if you find any departure or deviation from these standards, You can't just ignore it. You must refer to Essay 705, which deals with modifications to the opinion to ensure that the users of these financial statements are fully aware of the deviation.
Ultimately, your goal here is to issue an audit report expressing a clear opinion on whether the consolidated financial statements provide a true and fair view of the group's state of affairs as of the balance sheet date, and whether the consolidated profit and loss statement accurately reflects the results for the period. And remember, if a consolidated cash flow statement is included, you must also provide your opinion on whether that statement presents a true and fair view of the group's cash flows.
Now, let's look at the second, more complex scenario. What happens when the parent's auditor is not the auditor for all the components? In this situation, you have to step up your game and consider the requirements of Essay 600, which specifically deals with using the work of another auditor. If you feel it is necessary to make a specific reference to the work performed by these other auditors, you should look toward Essay 706 to guide how that reference is placed in your report.
As you move forward in your studies, keep in mind that there are further complexities to consider, such as when a component auditor uses a different accounting framework or a different auditing framework than the parent, or even cases where certain components aren't audited at all. But for now, focus on these two primary reporting paths as they form the foundation of your group audit reporting.
When a principal auditor relies on the work of other auditors for certain components of a group, they need to be transparent about the magnitude of that work. This means clearly stating how much of the financial statements were audited by others. You can do this in two ways, either by providing the aggregate rupee amounts or by using percentages of total assets, revenues, and cash flows. One key point to remember here is that these figures should be presented before any consolidation adjustments are made.
Now, a very important conceptual point for your exams. Mentioning that other auditors were involved is not a qualification of the audit opinion. It is simply an indication of divided responsibility. It tells the stakeholders that the responsibility for those specific components rests with the other auditors, while the principal auditor takes responsibility for the consolidated whole.
But what happens when the component is in another country and uses a different accounting framework? For example, a subsidiary in the US might use US GAAP, while the parent company in India uses Ind AS. In such cases, the local auditor might not be familiar with the parent's GAAP and cannot report on it. In the first scenario, the component prepares its statements using its local GAAP. Then the parent's management performs a conversion to align those statements with the group's accounting framework. As the principal auditor, you must audit these conversion adjustments to ensure the information is suitable for consolidation.
Alternatively, the group can provide a group accounting manual. This manual outlines all the policies and disclosure requirements the parent wants. The component then prepares its financial statements directly based on these group policies. This makes life much easier because the local component auditor can then audit and issue a report specifically stating that the statements are in accordance with the group's accounting policies.
Now, let's dive into the critical aspects of group audits. This is a vital area for your CA final exams, so let's break it down into 3 clear parts.
First, let's talk about the accounting framework. Imagine a parent company with several components. To make things simple, the parent auditor often asks the components to report using the group accounting policies. Now, as the principal auditor, you can't just take this for granted. You must perform procedures to ensure these group policies actually comply with the GAAP applicable to the parent's financial statements. Why is this so important? Because if the components use the same policies as the parent, the data is directly usable. It saves you the massive headache of having to audit the differences between the component's local basis and the consolidated basis. Once this is sorted, you can then decide whether to rely on the component auditor's report and if you want to reference it in your own final report.
Moving on to the auditing framework. Consistency is key here. In India, we generally follow Indian GAAs. For a parent auditor to comfortably rely on and refer to a component auditor's work, that component audit should also be conducted under a framework that corresponds to Indian GAAs. This alignment ensures that the quality and nature of the evidence are consistent across the entire group.
Finally, let's address what happens when components are not audited. In an ideal world, every single component in a consolidated statement should be audited or subjected to specific audit procedures. This can be done by you, the principal auditor, or by the component auditor. But if some components remain unaudited, you have a potential problem. You haven't obtained sufficient appropriate audit evidence for those specific balances. In this scenario, you must evaluate both the qualitative and quantitative impact of these unaudited amounts. If the impact is significant, you'll need to look at SA 705 to determine if a modification to your audit opinion is necessary.
All right, let's dive into these practical scenarios from your advanced auditing material. These test your understanding cases are gold because they bridge the gap between theory and the actual exam.
First, let's look at the case of CA Cajal and Rubik Paints and Chemicals Limited. Here, Cajal is auditing consolidated financial statements and needs written representations from the parent's management. Now, remember, when we talk about consolidated statements, the parent's management is responsible for the entire group's reporting. So, the written representation should specifically cover things like the completeness of the list of subsidiaries, associates, and joint ventures. They should confirm that the parent has provided all the necessary financial information from these entities and that the consolidation process, including the elimination of intra-group transactions, has been done accurately. Essentially, the management is confirming that they've given the auditor a full and honest picture of the group's health.
Now, let's move to the second scenario involving CAM&D Limited. This is a classic case of auditing a group with multiple subsidiaries, including some located outside India. The core issue here is that CAM is relying on the work of other auditors for 8 different subsidiaries. When you have this situation, the auditor needs to decide how to communicate this in the audit report. Since the subsidiaries are significant and some are foreign, CAM should consider mentioning the fact that the consolidated financial statements include the financial information of these subsidiaries, which were audited by other auditors.
Specifically, for those 2 foreign subsidiaries, CAM must acknowledge that their financial statements were prepared according to the accounting principles of their own countries and audited under the auditing standards applicable in those jurisdictions. If CAM decides to refer to the other auditors, he should do so in a way that doesn't diminish his own responsibility, but it provides transparency to the shareholders. To put this into practice, here is how you would draft that paragraph in the audit report. The consolidated financial statements of D&D Limited include the financial information of 8 subsidiaries, which were audited by other auditors. We have relied on the reports issued by these auditors. Furthermore, 2 of these subsidiaries are located outside India, and their financial statements have been prepared in accordance with the accounting principles generally accepted in their respective countries and audited under the auditing standards applicable in those countries.
Finally, just a quick reminder of the key takeaways here. Whenever a parent company prepares consolidated statements, they must strictly follow the applicable framework, which means as 21 if they follow accounting standards, or IND as 110 if they are under Indian accounting standards. Keep these distinctions clear, and you'll nail this section.
Now, let's dive into the critical concepts of group audits. When we talk about consolidated financial statements, the first thing you need to remember is consistency. To the extent possible, these statements should follow the same format that the parent company uses for its own separate financial statements. This isn't just a best practice, it's a legal requirement. Under Section 129, subsection 3 of the Companies Act 2013, if a company has subsidiaries, associates, or joint ventures, it must prepare consolidated financial statements in the same form and manner as its own. Furthermore, Section 129, subsection 4 tells us that all the rules regarding the preparation, adoption, and audit of a holding company's own statements apply, mutatis mutandis, to the consolidated statements as well.
Now, let's clarify the roles. The responsibility for preparing and presenting these consolidated statements rests squarely with the management of the parent company. As the principal auditor, your job is to express an opinion on whether these statements are prepared, in all material respects, according to the applicable financial reporting framework and the requirements of the Companies Act.
You might be wondering which standards to apply here. The answer is simple. The standards on auditing, statements, and guidance notes issued by the ICAI apply to consolidated audits in the exact same way they apply to standalone audits.
But here is where it gets practical. When you accept a consolidated audit engagement, you must honestly assess whether you can express an opinion based on your work alone. If you realize your own participation isn't sufficient, which is common in large groups, you should consider leveraging the work of other auditors.
Of course, effective planning is key to ensuring the audit is efficient and timely. During this process, you need to pay special attention to consolidation adjustments. There are two types you must distinguish. First, we have permanent consolidation adjustments. These are the ones made only during the initial consolidation or whenever there's a change in shareholding. Keep these in mind as you move forward through the group audit process.
Now, let's dive into the nuances of auditing consolidated financial statements. When we talk about consolidation, we encounter two types of adjustments. First, we have those related to a particular entity being consolidated. Think of things like calculating goodwill, capital reserves, or determining the equity attributable to minority shareholders. Then we have current period adjustments. These are the ones made in the actual accounting period of consolidation, such as eliminating intergroup transactions and balancing out intercompany accounts.
As an auditor, you'll typically find yourself in one of two scenarios. Either you are the auditor for both the parent company and all its components, or you are the parent's auditor but not the auditor for some of the components. In the latter case, you'll need to rely on the work of other auditors.
When it comes to reporting, you must keep your standards on auditing close at hand. Specifically, refer to SA 700 for forming your opinion, SA 705 if you need to modify that opinion, and SA 706 for adding emphasis of matter or other matter paragraphs. And remember, if you've relied on other auditors, SA 600 is your guiding standard for using the work of another auditor.
One critical point to watch out for is when one or more components remain unaudited. If this happens, you must evaluate whether a modification to your report is necessary. Why? Because if a component isn't audited, you haven't obtained sufficient appropriate audit evidence for those specific consolidated balances, and that is a significant gap that must be addressed in your reporting. Keep these connections between the standards and the practical scenarios in mind, and you'll master this section with ease.